thank you so much. I'm thrilled to be here with you guys. It's really awesome way to start the year off. I mean, there's a lot going on right now that is causing market moves. Some of them, very unfortunate. The situation that we have with this coronavirus is causing some market moves as well. But the market was really priced for perfection anyway. We've been talking about, if you saw any of my updates of late in the beginning, talked about the high probability of a pullback in the stock market. And that probability looks like it's coming to fruition right now. It was just one of many things that could have caused that, and that would have caused bonds to rally. We said once the bond market got under, if you wanted to use, mortgages are based on mortgage-backed securities, but if you want to use the 10-year treasury as a proxy, we were really carefully watching that level of 1779 on the 10-year, call it 178 on the 10-year. It was a really strong floor. Then we thought that once we broke through there, there was a couple of smaller layers that once we got there, we felt we could go down to 151 on the 10-year, call it 150. And while a lot of people thought that the 10-year was going to go to 2.5, we were pretty steadfast in thinking that that was not going to be happening. We thought that we'd see rates get lower. And sure enough, we're now, let's call it 161, 162 on the 10-year. And if we get some follow through in the stock market, I think we will see that 150 tested and challenged in short order. I really think that you've got a good chance to be there. The wild card is how does the stock market respond to so this news about the coronavirus? Is very troubling, of course, because when you think about this, I mean, think about it just logically. I'm sure everybody who's listening has thought about, just fears for yourself, for your kids. And when those fears start to get larger, like they are in China right now, do I go to a movie? Do I go out to dinner? Do I go to shopping malls? Do I go where people congregate and increase my risk of contracting this potentially, life-threatening virus? And as people take a step back, those businesses slow, and China's experiencing that now. But to some extent, here even in the United States, I've talked to people who are like, well, I'm not so sure if I want to go to a shopping mall or a movie theater or a restaurant. If this gets worse, and let's pray to God it doesn't, but if it gets worse, and I have this suspicion that this probably develops a little further and gets worse before hopefully getting better quickly, that it will take a bit of a toll on the economy here. And that's what the stock market's reacting to right now. And the safe haven is the bond market. So we'll see how this kind of develops. But
good thing, and now I don't know how I can.
Somebody's unmuted there.
So thing shut down.
I don't know if you have the opportunity to global mute everybody.
There we go. All right.
Well, I think you got me back now. Okay. Thank you for doing that, James. Always happens, right, in some of these things. People mistakenly forget to mute, but we're back. So listen, that's kind of where we are. I could show you a couple of things on the slides that I could share with everybody. Let me just show you real quick a couple of things, specifically what I'm talking about, just to bring you current. And we're going to take a look right now first at where we are with respect to the marketplace. So here you see the yield on the 10-year treasury. And I just want to show you a couple of things and why we were looking at this. I'm going to spread this out a little bit. See this level here, this 179 level, 177.9 level, right? 1779. This was a really tough floor. Once we got underneath it, we thought there was a lot of room to go. 167 was a potential area there, but we thought that we'd get all the way down to 151. Why 151? Well, I'll show you here. You could take a look here and you could just draw this line here at 151, that previous bottom. I think that we've got a good shot to go there. And then the next stop is around 142 here. Those are two areas that I could see the 10-year approaching and getting to in, I think we could hit 151 in the very, very near future if the stock market does poor. Let's take a quick look at the stock market. Now, stocks have recovered to some extent. They're off their worst levels, but this two-day pattern here, we've got a long uptrend. And when you see a long uptrend, then you see kind of an up day followed by this big down day where the body of the up day is inside the body of the down day. It's a Japanese candlestick pattern signal. It's very reliable. It's called a bearish engulfing pattern. We said this on Friday, and we said we expect to see some follow-through losses on Monday. I didn't expect it to be this big, but we were correct. We did get some big losses today, and this tends to have follow-through. When you see something like this, it's usually not a one and done. It has follow through. This is another indicator. It's called a stochastic indicator that does typically have some follow through. You saw one roll over here from very high levels where you get the black line crossing under the red line. And yes, we did get follow through, not extensively, but now you have a different signal as well. So you might get some extensive follow through. Who knows where? Around 3,200 on the S&P. It's about 50 points lower. That should give the bond market a chance to get to, on the 10-year, about 150. And as far as mortgage bonds go, if we take a quick look at mortgage bonds, I think that you can get, at least, another 25 basis points in price, maybe more. Maybe you get another eighth in yield before it starts to get a little bit top heavy. But then, of course, the news will have to play a role. But what I wanted to do is I wanted to kind of also go through with you what I think is really important for you, and that is your time is right now in the industry. There are very rarely situations or opportunities that are so favorable. You have a hot housing market, you have low rates, and something people don't consider is you have people with equity in their homes. So this is the time for you to really capitalize on this. You don't want to let this opportunity pass you by. You don't want to be on the sidelines. You don't want to be saying, wow, I really wish I would have kind of capitalized on that, or wish that I had more understanding that what a great and rare opportunity it was. Listen, team, just think about 9 months ago. Okay, not 9 years ago, 9 months ago. Everybody was worried about margin compression. People were kind of leaving the business. Heck, I saw somebody, I was at a shopping mall here in New Jersey, and it was somebody I knew from the mortgage business. He had left the business and he was working at Foot Locker. He had the freaking uniform, the referee uniform on and everything. This is, people were leaving the business and worried just 9 months ago, and now everybody's fat and happy. I just want you to understand that things can change. And this time that you have right now is when you really need to capitalize on. So, this is when you have to kill it. You have to stay longer. You have to work harder. You have to go out on weekends. This is when you have to look. I get the whole life balance thing, but sometimes when rare opportunities come around, you have to be completely out of balance to gain better future life balance. This is one of those opportunities that you have to put in every effort you can to kill it, because everything is on your side right now. So yes, your time is right now. So a copy of my cover of my new book called Money in the Streets, very inspirational, wonderful book talking about finding opportunities. I hope you guys decide to pick it up. But while there's great opportunities, there's also a lot of concerns. iBuyers are really growing, and it's troublesome. It's not just Zillow, it's OfferPad, it's Open Door, it's RealSure, it's Redfin, and there will be, mark my words, there will be more. And these people are ugly, they're dirty, they're ruthless, and they want to replace you. Have you seen the segment from a couple of weeks ago from Better.com CEO on CNBC saying that you should not work with an individual like you? Don't work with you. Why? Because you'll discriminate against them. I mean, really? I mean, that's such an ugly card. They're saying you work with an online lender because they won't be able to discriminate. And if they work with you in person, you'll discriminate against them, and they will strike. They're doing this. They're lying, and they're trying to strike fear in people's hearts. These people don't play fair. They play dirty, and they fight dirty. So you have to raise your game. You have to be better, because otherwise, if you're not an advisor, if you're a salesperson, and don't tell me, oh yeah, I'm an advisor, without really understanding, because you can't give what you don't have. And if you're really an advisor, I mean, do you really understand the markets? Did you understand what I went through in the first 3 or 4 minutes? Did you? Could you say that to your customer? Because if you don't, are you really an advisor? Do you understand what that means? Do you understand what the opportunities are going forward in local real estate markets? That's what makes you an advisor. And that's what the fintech companies can't compete with. And that's what your realtors need, because, by the way, your realtors have a giant target on their back. And don't think that you're immune. If realtors go out of business and you depend on them for referrals, where's that leave you? So leaves you like a travel agent. Travel agents have all become extinct, and they thought they were advisors as well, but they were just salespeople who believed their own garbage. Okay, don't fall into that trap, because you've got this guy and many others coming after you. Richard Barton, the CEO of Zillow, was just named the most powerful man in real estate. That's right, the most powerful man in real estate. And he's very focused on replacing you and replacing real estate agents. Says we don't need him, tells his shareholders we don't need him, says he's going to replace you. And we need to be careful of it, because he did it already to one industry. He wants to do it to ours. He was the CEO of Expedia, as was Derek Khosrowshahi, who is now the CEO of Uber. So these people have a mission to create enormous change and disruption. And unfortunately, we can't get caught in those crosshairs. And the way to protect ourselves is to be an advisor. Now, the stock market was priced for perfection. It's been really driven by quantitative easing. You know, the Fed's been pumping $100 billion a month into quantitative easing. And the result has been the stock market has been following along in a perfect correlation since October. The thing of it is, though, team, is that when you have this white line, Fed's pumping money in, and the orange line, the stock market corresponding, when the Fed does pull the plug, what does that do to the stock market? It more than likely causes distress in the stock market. You are already seeing that even with the Fed pumping money in. And when you see this start to happen, you get the results you're getting today, where the beneficiary is the bond market. And I think that we will see that take place. And you're also increasing the chance as time goes on of a recession, because recessions are cyclical. They're going to happen. It's just a matter of when, whether it happens this year or next year. And there's a high probability it will happen within that time period. We have to understand what the results of that are. And the results are lower rates. So if we look back in history, the last recession, in a 1 year and couple of month period, you see rates went from 6% on mortgages to 4.875. That's going to give you a lot of opportunity to refinance and a lot of opportunity to get people in to qualify for more home or qualify for a home they didn't previously. The previous recession was 7 3/8 and 6 3/4 in just a short 6 months. That's a big drop. How about this? 11 to 8.75, 2.25% in 9 months. And how about 18 to 13, 5% in a little over a year? I know that 13 doesn't sound very attractive, but if you're paying 18, you're doing a lot of refinancing at 13, and people can take advantage of that in a couple of different ways. If you're purchasing a home, I'd advise people today to stretch a little further, because you're going to have an opportunity to refinance in the next year or two, and you'll get those payments down. So I'm not saying put yourself in an uncomfortable position, but stretch a little bit further, because you'll get relief and you'll be able to buy the home that you really wanted to have. In addition to that, when you're talking to people today, knowing what you know here and knowing that there's a recession likely in the next year or two, that means rates are going to drop to where their lowest levels in the history of interest rates that we've seen. Based upon that, don't put people in with a lot of points. If you could avoid paying some closing costs by taking a higher rate, do that. Let everybody else fight over low rate. Think about a higher rate inclusive of closing costs, and don't pay upfront MI. You need MI? Do monthly MI. Upfront MI is a foolish game because it takes about 4 years to break even, and you will have refinanced or moved within that time frame. So these are the types of discussions an advisor has. But you can't fake it. You got to know it. And if all this is sounding new to you, don't get overwhelmed by it. It's okay. You can learn this stuff. It's nobody comes out of the womb being able to understand how to qualify somebody, right? Listen, if you understand the mortgage business, understanding how rates work and this and that, it's not that complicated if it's broken down correctly for you. Now, I'll tell you another thing that's important is the housing market. And that's really the lifeblood of what we do. And we need a healthy housing market because it generates equity, it generates wealth. It allows us to do transactions that way for both purchases and refinances. So what would the health of the housing market be during a recession? I know the media is going to mistake this and say all kinds of bad things, but it's just not true. The gray areas are recessions. The blue lines, the Case-Shiller Housing Price Index, which shows you the appreciation in homes. And you can see recession, homes go up in value, and then a lot more. Recession, homes go up in value and more. Recession, homes go up in value and a lot more. Recession, homes go up in value a whole heck of a lot more. Recession, homes go up a lot and then go crazy. This was the housing bubble. And the housing bubble was caused more by demographics than anything else. And then to make up for the lack of demographics of less people than homes being built, there's too many homes built and not enough people to absorb them. So they juiced the qualifications and went to a 70% home ownership and caused that by 100 LTV, 580 FICO, no income, no asset, no job, no nothing. Fog up this mirror and you're approved. That's what caused the housing bubble, and that led us into a recession. So it wasn't the recession that caused home prices to drop. In fact, the recession, home prices went up and up a lot more. It was the housing bubble itself that helped us go into a recession. And when we were, home prices actually tried to go up not once, but twice, but under the weight of foreclosures and short sales, dropped a little bit more before doing nothing but go up for the past 8 years. And that's where I see things continuing. It's just too much demand. The reason why home values have hung in there during recessions, interest rates. Interest rates go down a lot, make home purchasing better than renting by a wider margin, and they also allow a lot more people to qualify, which causes the home market to do pretty well during recessions. I anticipate the same thing will happen. There's too much demand, not enough supply. And you know I've made a lot of calls. James did not mention, but I did win the Crystal Ball Award for being the most accurate real estate forecaster in the United States, according to Zillow and Pulsenomics. And I stand by these forecasts. I think that we've been proven right for the past 8 years. I think we're going to continue to see that. But I've also made quite a few calls on rates. Made them on CNBC where it was very unpopular. Made them all over the industry last May. When the 10-year was at 2.53%, I said it's going to 1.39. And while everybody else thought it would go over 3%, we didn't quite hit 1.39. We got to 1.42, but it was a dramatic decline in rates, 111 basis points decline when everybody thought it would go up 100 basis points. So what I'm telling you is our prediction right now is to see 151 in short order. And then within the next year or so, when the recession comes around, you will see the lowest rates you've ever seen, probably about 1% on the 10-year, maybe even less than that. But even at this level, you're talking about maybe 5/8 lower in rate than where you are today. So imagine where your rates are today, imagine 5/8 lower, and imagine the great opportunity to refinance for people buying today and everybody in your pipeline that you have to get to. And when we talk about refinancing, don't be afraid to do a lot of refinancing. People like sheepishly say, they do a lot. Everybody thinks that you got to be proud to say, oh, I'm 98% purchase. I mean, are you kidding me? I mean, really? Right now, 62% of all loans are refinances. So if you're not doing it, you're not getting your share. And will you please think about the customers that you sat with and you talked to, and you tell all these people that, hey, I'm going to take care of you. I'll be there for you. But if you don't do their refinances, are you just ignoring them? And are you not servicing your customers? You have to do these refinances. And people talk to their customers and say this thing like, look, you always count. I'm going to be your lender for life. I think, first of all, I just hate the way that sounds. It sounds like you want to give them herpes, So lender for life, please just think twice about saying it and think more about being a person that they can count on. You have to be the one that they rely upon. You want to beat fintech. Don't let them steal these customers, because if you don't refinance them, somebody else will. Trust me, there's no shortage of ways for people to know. Social media, mail, TV. They know that rates give them the opportunity to refinance. Black Knight just said 9.4 million people can benefit from a refinance right now, 0.75%. So they're going to do it. If they don't do it with you, you know what the penalty is? You lost the deal, you lost the money, but you lost the referrals that would have come and their future transactions. And if they're dealing with a real estate agent, you're going to lose that too. So please make sure that you understand that and work with that for this. Okay. Now, the other thing here is that when you do a refinance, let's make sure we do the refinance correctly, please. Okay. I hear terrible things when people do refinances, like as simple as understanding how long it takes for your closing costs to be made up. Like, for example, I'm gonna ask you this question. You could put it in the chat window. I pulled up the chat window, so if you can pull up your chat window too, so we can kind of communicate together, because I'm going to talk to you here. So here we go. Your client purchased a home 1.5 years ago. The purchase price was $500. They took out a loan of $400. They put 20% down, and today you notice that you could save them some money. So you could save them 7/8% on a 30-year fixed. That's $230 a month on that loan. Great, awesome. 15-year, you could save them 1 3/8%, but because you're going to a 15-year, the payment would go up by $709. So now, I know that's going to be different. If you're in New York and Florida, your closing costs are a little bit more, but we're just going to use for argument's sake here. Your closing costs to do this refinance are $2,300. So as an advisor, I want that customer says, okay, so if I take that 30-year, how long is it going to take for me to break even? So what's your answer? Let's see who can do it. Don't use a calculator. Just do the math in your head, because you got to do math in your head. So I'm seeing people in the chat window. Anybody else know? I see people putting them in here. So everybody's saying 10 months. I gotcha, and that's great. But the thing is that when we take a look at this, we have to calculate the fact that when you do a break even, everybody bases it on payment, but payment's not a cost. See, for that matter, how would you figure a break even on the 15-year? The 15-year is, if you think about it, it's going up in payment $709. So $709 a month more. When will I ever break even? Right? You can't. How do I eat into that $2,300 in closing costs? So you can't look at payment. Here's how you look at it. If you're going to save $230 a month based on payment, that's one thing, but it's not cost. Cost is your interest. See, your payment's made up of two things, principal and interest. Principal is not a cost. The only aspect that's a cost is the interest, and the difference in interest is $264 a month. So that's what you're saving every month. The other $34 goes towards principal. It's an add-on to principal. So if you want to figure out how long it breaks even, it really is not going to break even in 10 months, like everybody would think by doing that. It is 9 months because it's 264. And now what you also will see happen oftentimes is that people won't get this concept, and you can really beat your competition. You can beat the fintech companies. You can be more of an advisor to your customer. Now back to that 15-year. Well, the 15-year meant you're saving a lot of interest. Instead of paying $1,534, you're saving paying $1,032. You're saving $502 a month. So I'm paying an extra $700 in payment. I'm saving $500 in interest. No wonder why I'm paying an extra $1,200 more that's going towards principal. And that's the real key. Your payment's going up $709 plus the $500 in saving. That's $1,200 towards principal. You would think that this would be something people would know in our industry, like in the first couple of days of getting into it, but nobody teaches this. Nobody talks about it, and nobody knows it, which is what gives you an enormous advantage to beat your competition. Now, something else I say, I even see it in the chat windows, and you tell me this. I mean, we know in the 15-year, your break even is closer to 5 months, but what about that first payment? What about skipping a payment? Do you skip payments? You skip one? How many payments do you skip when you do somebody's refinance? You skip 1, 2 payments? How many do you skip? Who could tell me that? I see people talking about it already. Anybody else? How many payments do you skip? I see some answers coming in. So go ahead, type in there. Let's great. Okay. So we've got a good sampling here. Some people saying you skip no payments. Some people say you skip 1 payment. Some people saying you skip 2 payments. So what is it? And why is this so confusing? I mean, geez, you know, this is a lot of money. You know, some people saying you skip a principal payment. So there's interesting, all these answers. So let's get all of this down, okay? So here we go. Do you skip a payment at all? Now, you could have any months of the year, but let's just say somebody has a closing date, and that closing date is May the 6th. And May the 6th would lend people oftentimes to say, hey, you're going to skip May 1st payment. Don't make it. You're going to skip it. But team, let's remember this. Interest is very interesting. Interest is paid in arrears on a mortgage. It's paid in arrears when you give the bank your money. When the bank's giving you interest, you go and you give your money to the bank. Say you give them $1,000, and after you give them $1,000, you don't get your interest that day. You wait a month and then you get paid. Well, it's the same thing now where the bank is giving you money. You don't pay them their interest right away. You use their money for a month and then you pay them their interest. So unlike rent, which is paid the 1st of April for the month that will follow, interest on the 1st of May is paid for April. So you're not skipping this. You don't have to skip the payment. If you make the payment May 1st, well, great. Then you're caught up. If you don't make the payment May 1st, well, guess what's going to happen? You've got to give it to that old lender at the closing table. You have to pay this amount of interest and this amount of interim interest up until the 6th of May. That all goes to the previous lender. Now, you're not skipping principal, okay? Principal is your own money. So it's not a payment. Principal is never a payment. Principal is money that you are taking out of your checking account and putting it into a different forced savings account. Okay, it's your own money. So if you made this payment, the additional principal that you would make inclusive of this payment would reduce the principal balance. So it's just taking your own money and reducing principal balance. It's the same amount that you would be out of pocket. Here, if you don't make the payment, your principal balance would be slightly higher, but you're just paying the interest without the principal. So you're paying the same thing. You're never skipping this payment, team. Okay, this is what we have to understand. You're not skipping the payment. it's being collected. It just will be either collected here or here and here. Now, when we go into this period of time for the new lender, well, this is where it gets interesting because this is an odd period of time. So lenders want the payments to be on a monthly basis. So really your mortgage payment should be June 6th, like it would be on a car loan, but they don't do it that way. They want the payment on the first of each month. So this is an odd number of days. So what they say is, okay, you know what we're gonna do? We're gonna collect it at closing. So when we collect it at closing, this is the only time that you're paying interest in advance. So because you're paying interest in advance here, what you see happening is that this period of time will go into the APR calculation, contributing to making an already awful calculation, APR, and a meaningless, stupid calculation, even worse. Because when June 1st comes, you're squared up. So think about this. This goes into your APR. And do we all understand how APR works? So APR is interesting. You see, APR wants to try and say, how can I compare a couple of different loans? One that's got points and a lower rate versus no points and a higher rate, or different closing costs. So what APR is trying to do is allow you a calculation. But remember, the APR is only accurate if you're there for the entire period of loan, because it's scrunching all of those closing costs and it's spreading them out over, let's just say, a 30-year period. But what if you paid the loan off in 2 years or 3 years? Now you paid all those closing costs up front, and you didn't have time to get the benefit of the lower payment on that lower loan. So APR is always inaccurate unless you keep the loan for the entire 30 years. But in addition to that, it also assumes that a dollar today is worth exactly what a dollar would be 30 years from now. So there has never been an accurate APR. If you want an accurate APR, you don't do it the day that you're applying. That's the stupidest thing in the world to do. You do it after you paid off your loan, and then, and only then, can you calculate what your APR is, with one caveat: subject to not taking into consideration inflation. If you really want an accurate APR, it can only be calculated after you paid off the loan. Then you calculate it and account for inflation. That's the only way to accurately calculate APR. But if that wasn't bad enough, interim interest, when it goes into APR, it can sway things dramatically. So how does APR work? So APR works off of something called amount financed. So if you're borrowing $100,000, you know what your payment is on $100,000 at a specific rate. But if you figure in, but I took out a loan of $100,000, but I paid to get it. I paid $1,000 or $2,000 or $3,000 to get it. So APR is saying, well, that same payment you're making on $100,000, take that same payment, and if you were to base it on the $98,000 you netted after the cost of obtaining the money, that interest rate is called APR. And what they're doing to make it worse is they're taking this and they're putting interim interest in it. So what unscrupulous lenders do is they say, let's do it based on a closing on the last day of the month. Very small interim interest, doesn't increase APR too much. Somebody else who says, oh, if we base it on closing the first of the month, big interim interest affects APR because it lowers the amount financed, causing APR to increase dramatically. And even a lower rate could show a higher APR based upon the way that they disclose this. So please be mindful of this, and please know that there are many unscrupulous fintech lenders that do this that you have to combat against. APR is the stupidest calculation, especially since by June 1st, it's all a wash anyway. All right, so when's your first mortgage payment? It's July 1st, because when June 1st comes, you already made the payment here. You're not skipping it. You paid it in advance. So you make this payment at the closing table or the previous first of the month along with this payment. So you never skip a payment. So the correct answer is 0. Many of you had it. There are no skip payments. And so many people in our industry are confused about this, even people on this call. And you guys are good guys and gals. Okay, so I don't think you're trying to hurt anybody or harm anybody, but let's make sure we get it right. You never skip a payment. There's no free lunch. And anybody who says there is makes that just easier for you to beat them and prove that you're an advisor. Now let's talk a little bit about housing. And I want to show you that some fools are out there talking about that there's a housing bubble on the horizon. Really? A bubble, the definition of a bubble is there's too much product and not enough buyers. Okay, so prices come down. You have the exact opposite situation. Currently, inventory levels are at their lowest level in history. The two periods of the two periods where we did have problems in housing occurred when inventory was at its highest levels. You go back to 86, 87, you back to 2006, 2007, 2008, look at the inventory levels. So those had to get worked off. And once you got back to a more normal level, the housing market remained very strong. We are so far beneath that. There is such a shortage of housing. And the demographics are telling us that because of birth rates from 33 years ago, which represents the median age of a first-time home buyer, which increased 87, 88, 89, 90, those birth rates all increased. You're gonna have more and more first-time home buyers coming into the market over the next 6 years, and that's gonna pressure inventory levels even more. So no bubble in sight, more demand than supply supports pricing. And the other thing is people waiting longer to get married. Look, in the 60s, people are getting married at 20, having kids after that. Now people are getting married at 30, and for the most part, having kids in their 30s. So why is that so important? Because it's the single largest driver of home ownership. You take millennials today, oldest millennials just turning 39 this year. Pretty amazing, right, to think about that. Well, people ages 30 to 39, they are a good chunk of first-time home buyers. They remember the median age is 33. So what's interesting about the people in this age group, if you don't have any kids, the home ownership rate, even to age 39, 38%. 38%. So 62% of them are renting. Interesting. Or living at home with mom and dad. But it's the first kid that you have. You don't have to have, 6 kids in a minivan. That first kid changes the home ownership rate to 80%. If you have additional kids, yeah, it bumps it a little bit, but not much, to 82%. So it's very revealing. So what do we know? We know the biggest driver of the housing market to buy homes, first-time home buyer, is having a kid. So let's take a look and see what could kind of influence that. Let's see what people are searching on Google. So this Google index goes from 0 to 100, with 100 being the highest popularity on record, the lowest popularity. So starts off getting married for most people. So let's take a look at that first. Wedding registry. Well, back in 2008 when the market was bad, not as many people certainly getting married. Started to come back in 2012, but a lot of popularity now. And as far as having kids, man, in 2008, this was way down as far as baby registry, right? So why are you looking at the baby registry? Chances are people are having kids. So you can see it started to pick up in 2012, but look at it now. They're coming, team. They're coming. And what that's going to do is influence home ownership. In fact, the search term itself, homes for sale, right now, is at its highest level ever. So people are searching for homes. Yes, inventory is tight, but you're looking at a marketplace that's going to be very hot for a long time. And look, when you talk about the fact that home values are going to be under pressure and that it's going to be difficult, you have to make sure that when your house is on the market, it's marketed well. And do you have a great open house kit that doesn't only influence people with the fact that it looks beautiful, but that when people come there, they could not only see their product offerings, but see the cost of waiting. And I think this is key, because with the lack of inventory, people could shop for a home and they look for a home and they don't find something. Okay, they go to a few open houses maybe, and they don't want to bid up to what's being asked and they miss out. Well, if you show them the cost of waiting for every single market, we know what the level of appreciation is, both historically as well as what it is for the future. And when you take a look at something like this and you say, hey, wait a minute, in 6 months, that home value is going to go up. It's going to cause me to have to borrow more money. That means my payment's going to go up, but I would have lost appreciation and amortization of $12,000 for just 6 months. That's $2,000 a month. Maybe I should keep looking. Maybe I should bump my offer by $5,000. Real estate agents go nuts for this, team. It's the only open house kit that you could text that really sells the property and stays on their phone. And by the way, we could also look at the school systems, all the points of interest, Google Maps to it, all the places to eat. So it looks good. It's powerful. It is the open house kit to use. Now, the other thing you have to remember to do is you have to be a local celebrity. You have to create engagement. You have to use social media. And the best part about it, it's free. So do you have good content that you're putting on social media? That shouldn't all be business. It's got to be a little bit about you too, but it should not exclude business and your knowledge as well. So what we want to do is you want to be able to show that you're in the business, because a lot of your friends and contacts in social media don't even know that, and B, that you're knowledgeable and that you're a great resource. So what we do is we put many different scripts together for you in Social Studio that You have dozens of scripts that you could utilize. You can go to Social Studio and it'll build in all of your local data for your market as well. So it's built into the script. You could edit the script, you could save it, you could come up with your own scripts. And then what it'll do is it'll turn your computer or your phone into a teleprompter. And you could, this will scroll for you. You just read it. Looks like you're looking at the camera. You could change the scroll speed, the font size, boom, you record it, and then one click, post it to social media. It is the only one that does this, and people are getting unbelievable results. Whether you use our tool that we created, which makes it super easy, gives you the scripts, or not, you have to post videos that show off your knowledge and expertise and your professionalism so that people will be attracted to you. Now, the biggest thing that I'm going to tell you to do today is the annual client review and do more refinances. But not just rate and term refinances, because you're going to get squeezed out on rate and terms. And I'll show you why in a minute. But what you want to be able to do is really change your customer's life and save the money. And I want to show you that what you need to do is just reach out to them. And what I'm about to show you will help you to earn at least an extra $100,000 a year. And I mean that, that's extra $100,000 a year. And all you have to do is talk to 2 previous customers. So you call your previous customers, not by cherry picking, just go either alphabetical or by date, but just absolutely do a very simple discussion with that customer. So let's just say you commit to do this and you're going to start this today, or you're going to start tomorrow morning. So the first client that you pull up, either alphabetical or by date, you look and you say, oh goodness, they already have a 3.5% mortgage rate. How could I possibly help them today? And then what's worse is that they bought their home a few years ago, let's say a little more than 3 years ago. It was a $500,000 home. Their original loan amount was $400,000, so it's 20% down. No MI. How am I going to help somebody with 3.5% rate and no MI with the rates out now? And now, you know, their home value's gone up, right, in just about every market, and their payments on their mortgage through normal amortization has brought their mortgage balance down. But here's the bad news. Now I know your rate's nowhere near this, but what if your rate were 5%? And this is really important because rates aren't going to always be as attractive as they are now. There will be times where they go up, or more people will have refinanced to lower rates. And so how do we keep on working with those individuals and doing good for them, helping them to create wealth and also creating business for ourselves? So let's assume for a minute my rate's 5%. I might say, why would I even call this person? But when you do, you understand that even at the lower mortgage balance, it would still cost them $252 a month more to refinance with you at that higher rate, as well as the $4,000 in closing costs. Most people say it doesn't make sense. Well, it might make sense, and in most cases it will, but just follow along. You call the customer up and you ask them just simply what their debts are currently. And they say, well, yeah, I've got a car payment, Barry. Now, the average car payment in the United States at the end of 2019 was the average car loan rather was $32,000. So let's say that this person has a Chevy for $29,500. So they've got a car payment. They've also got about $20,000 in credit cards between Visa, MasterCard, and Discover. And over the holidays, they did some damage at Best Buy and Macy's for about $2,800 and $1,500 respectively. So I want to make sure that this looks to you like a reasonable client profile. And assuming that it does, well then, let's throw another debt in there. And let's say we got either alimony, student loan, child support, whatever. So another $650 a month. I think that this looks like a reasonable client profile with the understanding that everyone is different and individual, but I think that there is a reasonable sampling here and representation of what people's debts are. By the way, debt levels in the United States currently highest level in the history of our nation. So now, when we take a look at their overall picture, we say, well, look, you owe $377,500. If I include the $4,000 for closing costs, that's a $381 mortgage. $381 mortgage, going from 3.5% to 5% means it's going to cost me $252 a month more. But pay attention to this. Your current LTV, while you started off at an 80, because of appreciation and amortization, is currently 59. And for just about everybody on this call, it's like a no-brainer to do a cash-out refi to a 75. I know you could potentially do others, but let's just keep it simple. Let's just say 75. So the difference between their current 59 LTV and a 75 LTV is this white space here, which is in dollars, it tells you $99,000. What if we use some of the $99,000 that's accessible and paid off something like the car loan? What would that do? We'd increase the loan amount. What would that do to your payment? So click it. And when you do, we increase the loan amount to $411, but now I'm saving $167 a month. Heck, that feels pretty good. Let's take a look at the Visa, the MasterCard, the Discover. That's pretty good. What if we paid off the Best Buy and the Macy's? Now I can click on this all I want. It's not going to let me include the alimony because it knows you can't refi away your alimony payment. So it's not letting you do that. But if I were to just pay these debts off, I'd still have some more money. And now I'm saving $1,248 a month. That's pretty significant savings. So well, I'm not saying the person's going to do the refinance, but I think that we can probably agree that we certainly have a little bit more of their interest and their engagement here. Now, before we do, you still have some money here. Is there anything that you'd like to do with home improvement? Most people would like to do home improvement. You've got $44,000. And now, by the way, our software is so smart, it'll know where you are. And when it knows where you are, it'll suggest all the things that people are doing. Like, for example, in Florida, it knows there's not a lot of basements going on like there are here in New Jersey. But the number one thing people are doing in Florida is renovating the bathroom because the housing stock on average is 45 years old. So you've got that green bathroom that isn't the most attractive anymore. So let's, instead of one sink, put two sinks in there so you don't fight over it. Well, yes, I'd like to do that, Barry. If you take a look at what most people are doing, 72% of people in Florida are going to do one of these in the next 12 months. 72%. And 88% of them are going to take out a loan. And it's $23,000 at the average loan amount. So what we're doing here is saying, look, if you want to do this, how much do you need to borrow to finish the bathroom? Yeah, it's $15,000. I just don't have that cash. Well, you do. We could take it out of here. So if we borrow an extra $15,000, that's going to reduce our savings a little bit. How much? It'll drop it, but we're still saving $1,167. And here's the magic thing. Here it is. Is it a good idea for us to take short-term debt and put it into a long-term thing like a mortgage? Would that be in our best interest? Well, it is if you do one thing. You see, right now, you're at 3.5%. Right now, you're comfortable with your payments. Heck, look at your ratios. Okay, you're comfortable. So rather than pocketing this $1,167, you don't need it. Why don't we do the refinance, put your debts in a smarter position, and take this money that's found money that you would have never thought to have and include it in the payments on the new mortgage? What would that do? Well, I'll show you. What it would do is it would apply this $1,167 a month toward the new mortgage. We could either do it where they do it voluntarily, or we can do it and build it in. Their current balance right now before they do anything is $377. They've got this in debt, so let's roll it all into a new mortgage. But that new mortgage term is going to be 14 years and 11 months. What that's going to do is it's going to save them 12 years and 3 months because they currently have 27 years and 2 months left. When it change that, make it 14 years and 11 months, leaves 12 years and 3 months on their remaining mortgage. 12 years and 3 months. So when we take a look at that, team, you could see, 12 years and 3 months saved, pardon me. You could see that as far as payments go, the payments go from 326 of them remaining to 179. Imagine how good it's going to feel to save 147 payments of $3,000 a piece. It's amazing. Now, you don't have to wait that long, even just 5 years later. If they leave everything the same, they would have amortized $45,000. Under the new system, $116,000, which means they're going to free up or gain in equity for themselves, $71,000. How about 10 years, $165,000. And 14 years, $289,000. Could you use an extra $289,000, Mr. and Mrs. Client? Could you use an extra $289,000? Are you thinking about how you're going to get your kids through college? Well, here's your answer. Are you thinking about your own retirement? Hey, listen, all you guys on the call, everybody on the call, have you not thought about your own retirement? I mean, really, just think about that. Have you not? Has it not crossed your mind? Do I have enough money for my own retirement? Would an extra $300,000 help, especially since what's happened? Nothing's changed. Your payment has not changed. Okay, your payment has remained exactly the same. So this is all found money. The only thing that's changed is you now redid the bathroom. You got an extra $15,000 in cash out, and you're not fighting over the sink anymore and looking at the green sink. So this was showing somebody going from 3.5 with no MI to 5%. What if we actually saved the customer some money? It'd be $375,000. $375 if we are one of those 9.4 million people today that Black Knight says can benefit from saving 0.75%. This is life-changing, team. This is absolutely life-changing. How about in just 5 years saving them $136,000? $136,000 in 5 years net. Where are you going to get that? This is how you win customers. So remember I said you're going to make an extra $100,000 a year? If you talk to 2 people a day, right? That's all I asked you to do. 5 days a week. Don't even do it 7. That's 10 people. My question to you, you just tell me. You talk to 10 people and you show them this. You think you can get 1? You think you can get 1 out of 20? And if your average commission is $2,000, $3,000, $4,000, no. You're talking at least an extra $100,000 a year. But the best part about it is you're changing people's lives for the better. Now, somebody might say, well, are they going to up their credit cards again and charge them up? They might, but that's not because they did this refinance. They could do that today. When you get your mail today, how many credit card offers are you going to get? Pre-approved, $10,000, $20,000, pre-approved. How many are you going to get? 3 today, every day? Your customers have no problem if they wanted to access and indebt themselves more. At least here they have a fighting chance and they're starting from a better position. And maybe with your coaching and guidance, you can do that. Now you don't have to put this whole amount in. You could, and we allow you to do it. It's interactive. We send it to the customer. The customer can click on those and get excited and figure out what they want to put as built-in savings and what they want to have maybe some extra mad money. It's all available for you. It's so easy to use. I want to share a quick real life story. My landscaper, who makes a lot of money, top landscaper here in Colts Neck, New Jersey, makes over $600,000 a year, but had Lyme disease, got himself in some financial trouble. And like I said, the credit card companies just kept feeding him credit, and he got himself way over his head. And he came to me struggling and saying, I make a lot of money, but I am in bad shape, cannot get ahead, very, very distraught. So we started going over this. I actually opened up my laptop and started entering these numbers into our tool. And here's what we came up with. He's paying $27,788 a month. But like most people, he's got equity in his home. So what if we rolled this debt into the equity in his home? Here's what we did. We could save him $26,000. A true story. God's honest, true story. $26,000 a month in savings by doing this. Now, $26,000 a month. Here's what I said. You're distraught. You're in pain. Here's what I want you to do. I want you to take $10,000 of the savings and go blow it. Go have fun with you and your wife, Michelle. Enjoy yourself. Use the savings to have fun. But the remaining $16,000, we're going to apply towards principal. Okay? So we're splitting that savings here. By doing this, I'm building it in mandatory to his mortgage. Now, I'm not doing the mortgage. I don't do mortgage anymore. I referred it to my daughter, Nicole. And Nicole, who's an originator, she did the loan, built this in, and Gary's mortgage is a 2-year mortgage. So in 2 years, he's debt-free of all of his debts. Gets out of this hole. Net worth increase in 2 years, $465,000. Literally life-changing. You know, Gary was in tears. His wife was in tears. But the best part was when his son Michael drove to my house to thank me for changing his parents' life. You guys have the chance to do this every day. Do you want to battle it out with a fintech company? Or do you want to really give advice and really have fulfillment in this wonderful business that we are able to do good things in the world for? Doesn't take too much. Just change your way of thinking and you'll change the world. I'm telling you guys, you have this wonderful opportunity. And it's only because people have equity in their homes right now, as well as having been in a position where they've charged up a lot of debt. This is your ticket. It's your key. And it's got to be something you're doing. Why? Because 76% of mortgages today are below 5, 60% are below 4.5, and 39% are below 4%. These numbers are growing every day. Every refinance you do today increases these numbers, and everyone is doing them. And as rates drop as they have, and they're going to continue to drop a little more, these numbers are going to accelerate. What happens when they do take an eventual turn higher? You can't just be thinking rate and term, and you can't just be thinking purchases, because the iBuyer platform, as I showed you, is growing. You're under more pressure. The fintech companies, this is your golden ticket, team. And it's the best thing that you could do for your customer as well, and it'll give you the most fulfillment out of this business. Now, we do have a lot of tools in MBS Highway, team. I don't want to do a whole sales pitch with you. I just want to show you some things and a quick survey. I'm going to take 1 minute of your time. Every morning I do an update. And if you like some of the things we talked about today, I do about a 4 or 5 minute update. It's fun, actually. It's fun. Tell you whether you should lock or float. We'll alert you, of course, when you lock or float. So this way you're protected. And you know, listen, there's a lot of copycats out there. They're guessing at this stuff. I think we're very good at it. You know, I've been doing it for a long time. I created this model for our industry. I've been doing it for a long time. While people try and copy it, you know, because you could put a basket in a basketball in a basket, you're not LeBron James. Okay. We understand this stuff and we will help you make the decisions, but we'll also break down for you every morning, like I did at the start here, what to look for. And when you start listening to that and you start saying that to your customers, you will make more money and you will gain more referrals and you'll gain the confidence of more customers. You have to do that, team. We'll do a real estate report card for you in any market. And if you want to, by the way, Stacy, thank you for those very kind words. I really appreciate that kindness. When you see your current market, and I'm going to go over one real quick with you because I want to show it to you. This you should do with every single person that you talk to. I just showed you the debt consolidation tool. That is, look, there's a guy, he gave me permission to use his name. He came on stage. The guy, just like you, listen to me say this. The guy's name is Josh Metal. He's in Salt Lake City, Utah. He's such a rock star. He's a great producer because he's an implementer. He said, that's a great idea. I want to do that for my customers. You know, in the next 30 days, he made himself $165,000 using this tool in 30 days. 30 days, $165,000. Just this one idea, and made his customers all super, super happy. Wrote himself 37 loans in 30 days with this tool. He said, Barry, everybody I spoke to wanted to do it. It's like the easiest money I ever made. The cost of waiting, which is a tool I kind of touched upon. The buy versus rent tool, we don't have time to go over it, but man, it is unbelievable. And then, you know, if you want to compare loans, I know there's other tools out there. Nobody does it like we do. Nobody has the real estate data. Nobody has the forecast. We have historical data, man. You tell us when they bought the home and where, we'll tell you what it's worth today. Every zip code in the country. And this will give you what the customer just wants. You just show them 8 products. All they want to know is what's best for me. Okay, well, if you're here between 3 years and if you refinance or sell in 3 years, take a 30-year fixed, no MI, no points with this rate. If you are going to be there between years 3 and 6 or 5.5, take out that 7/1 arm. Here, take out the 30-year fixed. It'll just show you, and then you can click on and off these. It is such an amazing tool. I showed you how to become a local celebrity. We have a screen record. I know there's other tools that do screen recording. They're very nice and they're very effective. Ours is built in. We've got the best open house tool on the marketplace. We did a survey of our subscribers in the first 90 days. 90 days. They made on average $35,000 more. 90 days. Team, you should be doing this. How much does it cost? There's something special we're going to do for you today. Go to our site. You can go there right now, mbshighway.com. Go to pricing. Here's what you'll see. The monthly price that people pay quite often, $199.95. Annual is $18.99. But if you go to sign up on either one of these, hit sign up, and then there's a code that we have for you for today. Here's the code for today. Geneva. They posted it. If you sign up for MBS Highway, but put in Geneva, what this will do is it will take off $70 a month on the monthly or $900 for the year on the annual. So pretty significant savings. So you can get it for a year for $9.99 or $129.95 a month. And that's for everything that's included in MBS Highway. Now, Geneva has a special deal for their own people because their company subsidizes this. And if you have your entire branch, each individual will get a license as if they signed up on their own for this cost. It's pretty darn incredible. That's because Geneva is picking up the cost for your teammates. And this allows you just pay one thing for your branch. If you wanted everything, just as one fee. So even if you had 5 loan officers, 10 loan officers in a branch, it's one fee of $199, and every single person has access to it as if they all bought their own subscription at $199 a month apiece. So people, that is essentially where we are, but I do want to show you, if you'd like to take a look at some of the different markets around the country, we have a couple of minutes here. Put in where you are. Give me just give me a county and a state or a zip code, and I will put that in for you. And let's take a quick look at where we are, team. I'll put that in for you. All right, so Pam Beck, boy, you guys are good. My friend Ruth, it's nice to see you on here as well. So let's go really quickly to, and by the way, I'm doing these now because I got to go with the darn reading glasses. I used to be able to do it without, but at least I can see now with the small typing. So let's take a quick look. Okay, we're gonna pull up my screen one more time. But this time what we're going to do is we're going to go right into the real estate report. There are so many tools in here, by the way. But we're going to go into the real estate report card. And then what I'm going to do is I'm going to take a look at that chat window one more time. And we pull that up here. And I see 30338. So let's pull up 30338. So let's go to and looks like DeKalb, Georgia, or Fulton, Georgia, both share that zip code. But as you can see here, median home price, you have your price per square foot. I could change that to specifically, I could either put in an MLS number, or what I could do is I could, so let's say it's 349. Pop that in, make that change. I now instantly have that, and I could see how much I'm going to gain. I could see what the job picture is here. I could see what the housing stock is. I could see that there's a shortage in homes. I could see how many people are in population, renters, the biggest demographics here. Napa, California is something that somebody put in. So I'll go to the classic drop down, and we'll go to California, and we'll go to Napa. And when we do, here's what we see. Man, you're the top 10% in the country in historical appreciation, 5-year forecast, 1-year forecast, and median income. The median home price is $704,000. There's your cost per square foot. Even at the median home price, you can see what appreciation's been and what the forecast is. I mean, you're going to make a lot of money on buying a home in Napa. I know it's tough to find them, but if you do, this is what will turn people on. Why? There's nothing available. There's 2 homes available for every 1,000 people, and you have a need of 2,000 homes to be available per year. I'm sorry, there's 2,000 homes that are going to be formed each year, household formations. About 1,100 of those in Napa will be purchases of first-time homes by first-time home buyers, but builders are not putting up any homes. There's only 200 homes being built. So this is important. And then what you see here is that people say, well, what about affordability? Guys, in Napa, affordability hasn't changed since 2012, okay? It's still the same. In fact, affordability is getting better in Napa. Your income's double the national average. Your jobs are great. Your unemployment rate's off the charts low. This is something you should be sending. So you could co-brand this. You could send it by text. You could send it by email. You can co-brand this if you'd like to in a PDF. You can pick your realtor. So if Kathleen's my realtor, I could do it in Spanish with a click. Send this out, and here's what it looks like. I mean, really, shouldn't you be talking to every single one of your customers about this? I mean, why would you not talk to your customer about this? Every single one of your customers needs to know. Every realtor needs to know. They don't understand this. They don't know this. These are all great selling features. This is selling the way people buy a home. And by the way, it's amazing because, those fintech companies, they can't do this. So this is what you need to be doing. This is what an advisor does. And that was the whole point of today's talk. Now we're a minute over right now, so I don't want to go much over because I want to be respectful of your time. And I want to just see, I know so many people, and by the way, thank you for your kind words, Ruth. Thank you for saying it like that. You could, Vince, I love you too, brother. Thank you, man. Thank you so much. God bless you guys. You guys are really awesome. Is there any questions that I could ask before we go? Thank you, Jonathan. Thank you too. Any questions before we end?
Barry,
Joe,
thank you so much for being here today.
God bless you too, Mike. And James, thank you, brother. I really appreciate you. Thank you very much.
Hey, so that deal is just for today?
That deal with that code is for today, but it is for today, but you know what? I hate to kind of just make people feel that they're under pressure because I don't like that either. So I'm going to go tell our IT department, well, let's just extend that out for a week for you. So this way you could take your time. And by the way, everybody, just so you know, if you find that you tried it and you'll get your money back. Nobody wants to take your money here. We want you to be happy. Number one, we're doing this because we want to help you. And we want this to be something that you really find rewarding and good for you and for your customers. If you try it and you don't think it's for you, there's no questions asked. You get your money back immediately. So don't worry about that. But I do suggest you give it a try. And don't feel pressured. If you want to do it right now, great. I think you'll get a lot out of it. But in case you want to wait, we'll leave it for a week to give you time to think too. Is that
Well,
fair?
that's fair, Barry, and I appreciate you doing that. But I mean, whatever rate you have it at, definitely worth it. I've watched our loan officers really start to build their business using this tool and becoming more sophisticated in conversation. And that, you know, it's not only on the client end, they're going to attract a higher level of agent. They're going to attract a higher level of client that is going to purchase larger purchase prices. It's a win all the way around, worth every, I mean, I would pay way higher than that for this tool if I was originating right now.
Thanks, James.
So you guys, make sure you check it out. I'm going to throw the recording up into the group so you can watch it again. But we'll give you guys the link to register in the group as well here in about 10 minutes. Throw that up in there and let us know if you have any questions. But again, Barry, appreciate you being here. And hopefully we'll get to have you on again soon to update everybody as this year rolls on.
Just say the word, James. I'm happy to be here for you. I hope you all have a wonderful day. God bless you guys. Health, happy, prosperous, the new year, and let's do a lot of good out there. Talk to you guys soon.
Bye, Bear.
Bye-bye. And thank you for the kind words.